Alright guys, so the markets are up quite dramatically today with the S&P 500 up over 2%, the Nasdaq up about 3%. So I do want to talk about this bear market rally, how long this could potentially last, and really the key levels to be watching for, because right now in the markets, we finally got a bit of good news from the Fed, and it has been like 5 months since we have gotten any good news. Pretty much everything has been bad and there has not been a reason to bounce. Now we have a reason to pounce. How high are we going to go? How long will it last? And how potentially are you going to make the most amount of money? That's the most important thing. And then we will get into the key information you guys need to know about our favorite stock. So hit the like button, subscribe to the channel, source comments, questions, or concerns down below in the comment section. Get your free stocks with Webull, Moomoo, and Public down below in the description of this video. But without any further ado, let's talk about it. Ladies and gentlemen, we finally got good news. Like I said, that was from the Fed, essentially saying, hey, we're going to raise rates super aggressive. We're going to go past the neutral rate at about 2.5%, likely meaning they're going to go to 3 or 3.5% by roughly September, and then they're going to reassess policy. And when the Fed says reassess policy, that's basically saying like, hey, maybe we will stop raising rates as aggressively. Maybe we will come in and help the markets out a little bit by then. And by then, hopefully inflation is down. Hopefully energy prices are down and food prices are down. But that's the thing. The Fed really, at this point, they just need to raise rates regardless of what inflation is. Because if we are really going into recession, like most people think we are here in the next 3 to 18 months, then the Fed needs room to cut rates, because the last thing you want is high inflation, a recession, and the federal funds rate at pretty much zero. That's the last thing you want, because there's no way the Fed can actually step in and accommodate the market. So we've been talking about this for a while here on the channel, and the fact that the Fed kind of gave us an indication of when they could potentially stop raising rates is really good for long duration assets. If you guys don't know by now, long duration means you're buying a stock because you hope it'll be bigger in the future, right? Coca-Cola, something like that, is not long duration. You're not hoping the thing's going to be bigger in the future. It probably will be a little bit, but you're getting paid out the dividend, right? Now, if you're buying an AMC, a SoFi, a DraftKings, and a Firm, a Lucid, things like that, you want those companies to be much bigger in the future. And usually you end up paying a higher multiple for those kind of stocks. And when the Fed is raising rates, the economic outlook looks bad. The multiples for those stocks and what investors are willing to pay goes down. And that's exactly what we have seen with the Nasdaq falling as much as 31% year to date. I believe that was just a couple of days ago, not too long ago. We were down 31% in 5 months, the worst stock market we've seen in almost 100 years, at least to start off a new year. So we finally got that good news from the Fed. The markets are rallying, which it should happen for the foreseeable future until we get a bankruptcy, a large bankruptcy, or multiple bankruptcies, or the economic outlook deteriorates at an even faster pace and the Fed does not stop raising rates as aggressively. If something along those lines happens, that's going to be the thing that really breaks the market. But until that happens, I think a lot of bad news is priced in, and ultimately we have seen a lot of pain and carnage in a lot of our favorite stocks. But overall in the broad markets, pretty much everything at this point, minus a few oil companies, have gotten absolutely destroyed. Now on top of that, the Fed did warn about potential lack of oversight in broker-dealer markets, market makers, unregulated markets, where they were basically saying there needs to be more regulation, because if somebody goes under, that's going to be a big problem for the overall economic system. And that's basically what they were saying, is it would put a lot of burden on banks, broker dealers, and other clients as well, which was the first time that they actually came out and said that during the minutes report. So I think that kind of gives us a little bit of a hint of what is going on. Obviously when the markets drop like this, you're going to expect to see some bankruptcies, but who is out there actually taking these losses, and what will that do for the overall markets? That is the unknown question here at this point. Obviously China, Russia, those are going to be big issues as well if things come up. China lockdowns extend, or the war in Ukraine just continues to last forever and food and energy prices don't go down, you're in for a very deep recession. The longer oil stays up, the longer food prices stay up, and the Fed can't do anything about it. the deeper the recession is going to be. So if the war in Ukraine were to end tomorrow, there's a decent chance that not we might go into a small recession, but that we would ultimately bounce out of it very quickly. Now, if this war lasts another 6 months and oil stays over $100 a barrel for it would be a full year at that point, then you're going to be in for a pretty bad recession. And I don't even want to talk about like if this thing lasted years, because I mean, you could potentially talk about a Great Depression, but how do you profit from this when everything is all said and done? Well, you continue to buy the dip, and preferably what I've been doing is buying the dip a lot more and putting a lot more money to work, because this is really where your dollar cost averaging strategies make you the most amount of money. It's not when you're dollar cost averaging into the markets when the markets are going up, but it's really when you get these prolonged periods of downturns in the market is where you compound all of your gains. So that's exactly what I'm doing. I am buying long duration growth because it is so cheap. A lot of these stocks are worth less on a price to earnings basis or a price to sales basis than a lot of established staple or defensive companies. So when you have growth trading this cheap, I think it doesn't make I think it only makes sense to buy that growth instead of look for that quote unquote safety in your portfolio. But nonetheless, what do we have setting up for us tomorrow as far as economic data? Because it's actually going to be a pretty big day for a Friday. Usually you don't get a lot of very important economic data that comes out on Friday, but this time we do. 7:30 in the morning, you have the unemployment rate for May. You have non-farm payrolls for May expected to be major catalyst. And then at 9 a.m., right before the bell actually does start, you have ISM non-manufacturing PMI, and that's something the Fed does pay attention to. And that ultimately, if it goes down, is going to be very, very bullish. Now, I will say if the unemployment rate as well as the non-farm payrolls do start to go up a little bit, that might be bullish for the markets as well, because the Fed has acknowledged that basically they have all the room in the world to raise rates until the unemployment rate actually starts to come up, which it does not look like it is actually doing that as of right now. And that's exactly what we can see from the jobless claims that came out today. Initial jobless claims totaled 210,000, a decline of 8,000 from the previous week. And first quarter GDP was revised down to a 1.5% loss for an annual pace in the first quarter. That was worse than the Dow Jones estimate and the write down from the initially reported 1.4%. So if you're looking at the possibility of a recession, it looks like the GDP fell even worse than we expected during Q1 after all of these revisions were said and done. So if the next quarter GDP comes in negative, you are in a technical recession, but I think the markets have already figured, we're going into recession. So I don't know how big of a deal it would be. Might actually be a bullish thing for the markets because the Fed maybe wouldn't raise as aggressively. It's kind of weird, the kind of market that we are in. Like the last time GDP actually came out, the markets rallied about 2.5% that same day. So it was like bad news was good news, and it's like good news is bad news as of right now. So we'll see how all of that plays out. But really, I think the main opportunity here, besides trading options or anything else, is really just loading up on long duration companies that you can see being much bigger into the future, that have proof of concept. They don't necessarily have to be profitable, in my personal opinion, especially the stocks that are not profitable, that are trading off price to sales ratios, are incredibly cheap. Look at something like SoFi. Look at even AMC at a 1 price to sales ratio if they can get back to pre-COVID revenue numbers this year. That's pretty cheap for a price to sales ratio, especially for a company that is going to be expected to grow quite substantially, right? DraftKings, same boat. Affirm, you could argue the same boat as well. So I'm very bullish about the overall long-term trade, call it trade or investing journey we have ahead of us for the next 5 or 10 years here in the markets. But it's going to be very volatile for an extended period of time. But enough with the macro environment talk that we just have to go over, because it's very important when it comes down to AMC, when it comes down to your money overall. But let's get into the good stuff. What's going on with AMC today? Up about 1.68%. GameStop is up about 12%. Redbox has actually fallen quite a bit today, and I think this is kind of dragging down some of the meme stock momentum that we were seeing. They are now up 12%, but they were up as much as like 38-40% at one point today. Now, I just think the money is ping-ponging back and forth. So I think one day, you're going to see Redbox, GameStop doing well. The next day, it's going to be AMC, right? It's going to go back and forth, kind of like the markets go back and forth, like I said in the last video, with the NASDAQ and the Dow. One day the NASDAQ is up double what the Dow is. The next day the Dow is up double what the NASDAQ is up. So I do expect that kind of ping pong style movement within momentum stocks, just because a lot of people, that's what they're doing, right? They're just trading in and out of these stocks. Now, you are seeing retail inflows at nearly an all-time high despite market turbulence. So that goes to kind of support the claim that I am making here that, hey, you're just going to see a ping pong like action back and forth. Now, I will say the cost to borrow rate, if we look at the video I made yesterday, you guys can actually see that the cost to borrow rate was about 8% for yesterday, 7.94%. That was yesterday's video. Now it's sitting at about 15.03%. So the cost to borrow rates have essentially doubled overnight last night. And I think that is implying an even larger move that is coming due to the executive order. And I think it's as simple as that. I think that's why GameStop's cost to borrow rates went up so high. I think that's why AMC's cost to borrow rates are starting to go up, and why they will probably go up a lot higher. Now, the current short interest of free float is sitting at 22.57. Current short interest or shares that are sold short, 116.34 million, 100% utilization. That's pretty common these days. It's stayed at 100% for a very long time. Days to cover is sitting at 3.45. Shares out on loan at 170.08 million. Free flow out on loan about 33%. So all of this looking pretty damn good, if I do say so myself. Now, the option activity, 19 orders totaling 6.47 million, positive order value of 44%. Look at all of the calls coming through, specifically for July 15th and June 17th. Those look to be the major dates of expiration that hedge funds are actually targeting. And if we do go ahead and take a look at the Stocko Tracker data and go ahead and refresh this page, we can see about 26,000 calls that are in the money expiring tomorrow, about 137 calls, or 137,000 calls that are out of the money expiring tomorrow. But that big option expiration date, really the two ahead of us, is June 17th as well as July 15th. For June 17th, you have about 222,000 calls that are out of the money, 5,300 calls that are in the money, about 109,000 puts that are in the money, about 54,000 puts that are out of the money. So if we go ahead and take a look at the option activity, where a lot of this option open interest is actually held on that June 17th expiration, because you guys do know I think we're going to see a very substantial rally here over the next coming days and potentially coming weeks, especially around this executive order. But a lot of this option activity is held at some key strikes, like the $13 strike has about 4,200 for open interest, 4,100 open interest at the $14 strike, about 10,000 open interest at the 15, 5,300 at the 16, about almost 3,000 at the 17, 3,000 at the 18, and then once you get over 20 is really where you start to see the open interest really start to shoot up. And you could see about 15,000 for volume at the $20 strike just today for the June 17th option at the $20 strike, about 12,343 for open interest. You got 3,000, you got 11,000, 3,000, 6,000, 7,000, 3,000, and then you just get into the thousands all the way down. Really, you get to about 40. That's where the open interest really starts to drop off until about 45, and then the $46 strikes. At the $40 strike alone, you are looking at over 10,000 for open interest. And then if you get further out to the 50, 55, 60, that's where you start to get a lot, as well as all the way to 85. You have about 29,000 for open interest. So I think if we can break above 20, that's really when you're going to see the gamma ramp start to actually kick in, because that's where you have a lot more concentrated option activity. And considering these premiums are so cheap, like $20 call for June 17th is trading at $50. If the stock were to move up in a dramatic way, then the market maker's break even would be very low. It'd be $20.50 per share if you bought these options right now, right? And a lot of people have bought these options today, about 15,000 for volume on the day. So if you start to get up to, $20.70 per share, you're going to see even before then, right? $20.50 50 cents per share, or a little bit before that as well, $20, call it 40 cents per share, you're going to see the market makers that have to go out and buy a lot of stock, and that's going to help propel us along this option chain because the premiums are so cheap relative to how explosive AMC stock could move. So I personally do own some of the June 10th $20 strikes as well as the June 17th $20 strikes as well, and I'm looking forward to this rally that we are going to see because of the executive order. I think there's no way that somebody can make the argument that the executive order was not linked to the rally in January as well as in June. It's pretty straightforward and the evidence is clearly there, and you can see it reflected in the cost of borrow rate. Something is coming and I want to be fully a part of it. I don't want to be the one FOMOing in, but we love the FOMO buyers as well. That's why I say and portray this image that I don't care if you buy, hold, or sell AMC stock, because people that sold or we're looking at the stock, they're going to be the ones to FOMO in when the stock really does go bananas, right? For give you guys an ape term. So that's going to be all for this video. That's really what you guys need to know. Hit the like button, subscribe to the channel, source comments, questions, or concerns down below in the comment section. If you guys want to come trade with me live in real time, link down below in the pinned comment. We will be live in between 10 and 11 p.m. Eastern Standard Time for the nightly live stream. Thank you guys for watching, and I will see you in the next one.